Good evening, everyone. I wanted to begin by expressing my gratitude on behalf of the club for your attendance tonight. As you may already know, our club has slightly broadened our focus in order to expand the different areas that we plan to educate our members on. This includes exploring new asset classes and markets such as fixed income, commodities, cryptocurrency, foreign exchange, derivatives, and further building on our understanding of the equity market. Today, we begin our first event by exploring basic market fundamentals and diving deep into the equity market. We hope this session is very engaging and informative. Furthermore, we hope you can spread the word to your classmates, colleagues, and friends so we can further grow our community. Now, I would like to pass it over to Hamza to kick off our session.
Hello, everyone. Again, thank you, like Noah said, thank you for coming here today. Today, we'll be discussing basic market fundamentals and equities. I am the finance team lead for the equity division over at TRST. And today, we'll be taking first a look at market fundamentals, the asset classes that we cover over at TRST, and then we'll take a deep dive, like Noah said, into equities in specific. Share my screen with you all. So, for our schedule today, we'll first discuss what a stock is, how the price of stock is determined through supply and demand, market cyclicality, economic indicators, major asset classes, stock price determination, how to invest into the market, financial statement analysis, the key metrics and ratios, and how to pick the appropriate stock. We will have several Q&A sessions in between those specific topics for you all to pitch in and ask any questions that you have of interest. So, what is a stock? A stock is a share or an equity is a financial instrument and a major asset class that represents a specific ownership in a company. A share entitles the owner, a holder, to a proportionate claim on the company's earnings on an asset. Essentially, the way I like to think about it, think of it as a pie. When you purchase a certain share of a company, you now own a sliver of that pie, and therefore you own a percentage of that company. Ergo, once you own that slice of the company, your portion equals to the number of shares that you own over the number of shares outstanding in the market. There are two types of shareholders in the market, common and preferred, and the difference between those, common shareholders are typically residual claimants, meaning they get paid last after all debt holders, minority interest, and preferred shareholders get paid. Preferred shareholders, unlike common shareholders, get paid first. However, lack the right to vote in certain events. So let's take a look at how pricing of equities happen. It's a very simple supply and demand curve. Stock pricing happens naturally through basic supply and demand economics. For every transaction, there's a buyer who submits a bid and a seller who proposes an ask offer. You might see those on websites such as Yahoo Finance, such as Wealthsimple, or your local trade center. If more demand was to exist in the stock market, then the demand curve would shift to the right and we would see a higher price. If the supply was to shift to the right and supply was to increase in the market, we would see the supply curve, the blue line illustrated in the graph in your screens, shift to the right, and there go, the price would decrease. Therefore, we can kind of deduce a relationship between those at that an inverse shift in the demand and supply curve leads to the same outcome. There you go. If just to simplify that even more, when supply increases, price goes down, and when demand increases, price goes up, and vice versa. When demand goes down, the price decreases, and when supply goes down, the price increases. Let's take a look at a couple more examples of what and how price is determined through supply and demand, just to illustrate it a little bit better. If we look at the graph in the top left, we can see that there's an increase in demand for that specific stock. We see that when the demand shifts from the left to the right, from D1 to D2, we see an increase in the price, where price is on the left axis and the quantity of the stock itself is on the x-axis. Therefore, when demand increases, we see the demand curve shift from the middle all the way to the right, and therefore increasing the price upwards. Let's take a look at another example. If you look at the diagram on the top right of the screen, we can see a decrease in supply, where we see S1, which is the original supply curve, shift from S1 to S2. Therefore, supply decreased in that scenario. And then again, since there is less supply of that particular stock, we can then deduce that since there is less supply, more people would be bidding for that specific stock in comparison to the number of stocks available, and therefore the price would then again increase. If we were to combine those two situations simultaneously, which is what happens often in the stock market at a glance of a second, we can imagine that demand increases, shifting from D1 to D2, and then supply shift from S1 to S2, therefore driving the price higher than anticipated beforehand. So let's discuss market cyclicality. Market cycles are trends and patterns that emerge during different market environments. During different phases of market cycles, different asset classes and equities for that matter outperform others. So there's a general trend that we see in the stock market. We can see a peak, which is when stocks are performing the best. Then we see a distribution phase, a downtrend, where we see stocks begin to lose their value. Then we see a trough, which is what I personally characterize the state of the economy that we're in right now. During a trough, after a trough, we begin to see a markup phase where stocks begin to move, where stocks begin to gain traction, and we start seeing an increase in the stock market and stocks outperforming their previous years. At the bottom right graph, we can actually see an example of the S&P 500 over the last decade or so. We can see that trend in a similar fashion, where we see a decline in the 2020 pandemic announcements by the World Health Organization. And then after a certain period of time passes and the market corrects itself, we can see the accumulation and the up markup phase, where we see the stock market go up again. We are now going through personally, through my personal opinion, we are now going through a downturn phase where we are actually in a decline. A decline is typically considered when we have two consecutive quarters, i.e. two consecutive 3-month periods, where GDP growth is negative. That is currently what we are in, and that classifies us as a recessionary period. Markets typically self-correct over time and have a very general upward trend through as you can see on the top right graph. Just to take a quick look of history of US recessions. We can see there are different moments throughout time where we see a slight trend, where we see that trend on a smaller scale, on a much, much smaller scale. So if we take a look at, for instance, the Great Depression in 1930 to 1935, we see the downward trend of the graph. Then we see a slight incline after 1935 when the market begins to correct itself, leading us to the accumulation period where the market reaches its peak. We see that trend over time repeat itself, whether it's in the Wall Street crash, the Great Depression, the dot-com bubble, the 2008 crash, the 2020 pandemic recessionary environment, and the current recessionary environment. We see that trend repeat itself over and over again. Therefore, that's why certain investors try to outperform the market by remaining in it for such a long period of time, and therefore they actually make gains over time. Generally, the S&P market over the last 70 to 80 years or so has performed approximately on a return of 15% annually. If we look at it annualized and on an average term basis, 2022, for instance, returned an average of negative 17 to 18%. However, the year beforehand, 2021, we see a 25 to 26% increase in the market. Therefore, it averages throughout history to approximately a 15% increase per year for the stock market. It's important to note that all these sessions happen, all these recessionary environments happen, all these macroeconomic trends happen, and they pass by, and it's important to keep pushing through the adversities that happen through time. So what are some economic indicators that we look at in the economic and market? Several economic indicators stand out when assessing the state of the market. First of all, rising inflation. I think we can all agree that there has been a tremendous increase in inflation over the last 3 to 6 months, if not more. We see prices rising. We see commodities that we purchase on a daily level increase in their price, and we see regular items, household items that we purchase on a daily basis skyrocket. This is an indicator that people are no longer that prices are essentially increasing at a rapid pace, at a very rapid pace. Secondly, we see a rising CPI, which is the Consumer Price Index. The Consumer Price Index looks at a basket of products that consumer purchased during year one and during year two, and assess the change in price between them. If there's a significant increase in the price of that consumer basket, then we can tell that there has been, again, a rise in inflation and that consumers are no longer able to meet their demand. That is, again, what we are facing in this economy right now. Third, growing unemployment. Growing unemployment, as we can see at the moment, we have had several layoffs, whether it be from banks such as Wells Fargo, from tech industry, from the technology sector, from the energy and mining sector. There has been a huge shift where companies decide to lay off people in order to reduce their expenditures in order to mitigate the downturn of the recession. Fourth is an increase in the federal rate. We saw hopefully the last increase from the Federal Reserve today, this morning, of an increment of 25 basis points, i.e. 0.25%. The reason this happens is due to the fact that federal rates try to increase their overnight rates, so that in order to counter inflation, so that consumers and big industry no longer acquire debt and no longer expand, and therefore reduce their prices and reduce inflation. And finally, an inverted yield curve, which is what we can see on the top right of the graph. An inverted yield curve demonstrates that short-term bonds have a higher yield than long-term bonds. That is due to an increase in the overnight interest rate market, which is a huge indicator of a recessionary environment coming. The inverse of these 5 factors that I've just mentioned, a regular yield curve, or a decrease in Federal Reserve rate, decreasing unemployment, declining CPI, or a low level of inflation, would indicate a stronger economy and a more stable economy one that we find more favorable and then one that would be more beneficial for an equity holder. The graph on the top right is one that was provided by the Federal Reserve as of 2 days ago. It shows and it illustrates the yield curves for 1 month, 3 month, 1 year, 3-year, 5-year, 7-year, 10-year, and a 20-year and a 30-year bond. And it shows the yield expected of those bonds depending on their interest rate. So just take a quick break. That was quite a bit of information. If anyone has any question, please do so and raise your hand. If there aren't any questions, I forward.
If no one wants to ask one, I guess I'll go ahead. You lightly touched on the interest rate effect in economy, because that is a very important topic in the past few months as well. Could you explain a little bit more on how the interest rates and the mechanism of how it slows down the economy?
Yeah, of course. Interest rates are so essentially on a macroeconomic scale, interest rates rise, which provide banks with incentive to deposit their cash on hand to the central bank, provided the interest rate that they provide. When that happens, banks are less likely to provide debt and sources of debt to institutional organizations and personnel, which would lead to consumers to withdraw their spending, lower their spending, and therefore reduce the demand for certain products. When the demand declines for a certain product, and again, it turns to our supply and demand curve, we see the demand curve shift to the left, and i.e. prices slow down and decrease. The whole purpose of increasing interest rates is, again, to slow down big institutions and industries that borrow heavily and mass produce products, and consumers who are purchasing at high rates for their personal consumption in order to decrease demand from consumers and therefore decrease the prices of the industry. So if we go back to a regular decrease, okay, so this one, if we were to compare the top left graph, if demand was to shift to the left, we would see a decrease in the price itself, and therefore justifying the increase in interest rate. Does that answer your question?
Absolutely. Thanks.
Any other questions? Brandon.
Yeah. Hey, I had a question about the supply of stock supply. How do you have an how it can decrease? Is it just the company buying back its stock?
A decrease in the stock's price itself?
Yeah. And how that says decrease supply? It goes from S1 to S2.
A decrease. So a decrease in the supply wouldn't typically happen from the company itself. It could happen from the company buying back their own shares because they believe that the stock is underpriced itself. And a buyback program would essentially allow a company to buy back its own shares from the stock market due to their belief that the stock price is undervalued. When they do so, that leads to a shortage in the supply, as we can see from S1 to S2. And therefore, that would increase the price point of the stock itself. And therefore, at that point, the company would re-release their shares to the stock market at a higher price point. A decrease in the supply could also be from institutional investors, from personal investors, such as yourself. If you yourself own 100 shares of Apple and there are 1,000 shares out there, if you yourself were to hold on to those shares for a longer period of time, and didn't want to sell those shares to a buyer out there, you yourself would be lowering the supply of available shares out there for the market to purchase. And therefore, again, you would decrease the supply from S1 to S2, and that would increase the price itself.
Okay, thank you.
Any other questions?
Yeah, Hamza. Going back to the economic indicators, I would love to understand why an inverted yield curve is a recessionary indicator and how it differs from a regular yield curve.
Sure. A regular yield curve would have the inverse, where yields for shorter term bonds would be lower rather than long term bonds, due to the market belief that the current interest rate at a shorter term would yield them a higher return than investing at a longer term bond. So an inverted yield curve would have the opposite structure, going from shorter term with lower yield, and then when it reaches a longer term, it would have a larger yield. When interest rates increase, we see that the yield curve inverts due to the market belief that their returns on the market itself could be better on a shorter term. And therefore, the yield curve would invert itself, and we see a larger yield on a short-term basis, if that makes sense.
So does that correspond with the perception of higher risk in the short term as compared to the long term?
It does, of course. Again, people are willing to take people are willing to take a larger risk in the short term if they are expecting a larger demand. People are uncertain about the economic outcome in the near short term, and therefore they would be willing to invest at a shorter term bond in order to gain a larger yield. That is exactly like you said. There's a sort of risk and return factor to it. So people are expecting a riskier market at the moment. They can expect a larger yield. And vice versa.
Perfect. Thank you. Appreciate it.
No, any other questions? Move on. So there are six major asset classes that are typically covered by institutional investors: equities, fixed income securities, foreign exchange, cryptocurrency, real estate, cash and cash equivalents. At TRST, we only cover the ones highlighted in a darker green tone, which are equities, fixed income securities, foreign exchange, and cryptocurrency. For fixed income securities, such as illustrated in the inverted yield curve, are fixed income, like their name says. They provide you a specific coupon return on the investment that you make at a specific and denoted time. They provide you with a consistent income over time, or they could provide you with a zero coupon bond. They exist such as treasury bills, treasury bonds, T-bills, and so on. At foreign exchange, very similar to equities, is determined through supply and demand and market outlook on the foreign exchange itself. So if a certain currency has better market indicators, if it has a better political stability, if there's more demand for it, then the price of the exchange itself, the currency itself, would increase, and vice versa. Cryptocurrency is more, again, determined by supply and demand. There aren't as many indicators that are similar between cryptocurrency and equities, such as there are between equities and fixed income. However, cryptocurrency is more decentralized finance, where the removal of the third-party intermediaries, such as banks, is removed completely out of the picture. We will be having events about all three asset classes very soon, all three other asset classes very soon, that we will be covering different topics about such asset class. If we look at the risk and return of these asset classes, we can see that treasury bonds and high-grade bonds typically have a lower return than other asset classes. That is due to their lower risk. So if we look at a risk-free rate, what is denoted as a risk-free rate, that is typically a 10-year treasury government bond. The reason it is called a risk-free rate is because it has very little risk of the actual supplier of the bond itself defaulting. So treasury bonds, government bonds, or high-grade bonds would be those of a lower risk. However, they have lower return. High-grade bonds also include company bonds, corporate bonds, such as those provided by different companies, such as WSP, such as Tech Resources, or any other companies for that matter. You always see you always see bond rating next to companies, whether it's AAA for being the best, AA, triple B, and so on. Then we move on to qualitative stocks, which is what we cover. It's the equity market itself. Those have somewhat of a moderate risk and a much higher return than, say, corporate bonds. Like I said, the S&P market returns approximately around 15% per year. Then we have aggressive stocks, which are, again, either small cap stocks or penny stocks, for that matter, stocks that have a large risk factor. However, then again, they do provide a larger return. We have high yield bonds. Those are much riskier types of bonds with a higher chance of defaulting from the bond provider themselves. However, they do offer a much larger return for the risk that you take. Private equity is also one of those is also an asset class that has a higher risk and, again, a higher return. Cryptocurrency and foreign exchange would be somewhere along the right of all of those asset classes, as they are much more riskier. They are significantly riskier. But then again, they also could offer you a larger return and for the risk that you provide. We also see a very similar curve on the right, that this plays the return expected on a specific class in proportion to its potential risk. So again, government bonds and high yield fixed income securities provide a lower return than large company shares and small company shares. However, they do face a lower risk. So then again, it depends on the type of institutional investor and what they want out of their investment and the level of risk they are willing to take on. Some investors are interested in purchasing stocks for a long period of time, earning a stable return of around 10 to 15%. Some are looking to invest in bonds to get a stable source of income and not riskless. It has a lower risk to it, and they can guarantee receiving their money back to some degree. And some investors like to face on a higher risk, and then again they could either possibly gain a larger return or a lower return with cryptocurrency and foreign exchange. So then again, it depends on the type of institutional investor, what they prefer, what they like to invest in, and it depends on the return that they expect. Then again, if anyone has any questions about these, please go ahead and ask them now. If not, we can move on. Okay, so let's take a look at the asset class that I manage personally over at TRST, which is equities. As previously mentioned, stock prices on the stock market are determined by supply and demand of the stock market itself. Therefore, market sentiment and investor belief are what drive the actual value of the stock on the market itself. However, I'm not sure if any of you have seen this. Some analysts do provide insight on what they believe that the stock market is and how their belief on a certain stock, what its price should be, how much it should be valued, if it's overvalued, undervalued, and so on. So then again, market sentiment and market belief about a specific stock isn't the same as what analysts predict that a stock should be. Some investors believe that stocks such as Tesla or Apple or Google, for that matter, should be in the higher ranges, while some analysts, for instance, would say that these stocks are overvalued or undervalued, depending on their perspective on the market. So let's first take a step back and actually look at stock pitches themselves. Stock pitches could be either buy side or sell side, i.e., it either promotes buy or sell for the equity that it's mentioning. On the right-hand side, you can see a specific example of that. It's about tech resources with a price target of $67. That was a buy side example of a stock pitch. Some analysts also prefer a sell side of the specific stock, and they promote a perspective on the stock itself, that the stock is overvalued and why the market should not follow. Stock pitches all typically involve analyzing the company's overall performance, comparing it to industry, scrutinizing company financials, and assessing management guidance. Stock pitch will then provide an investment thesis as to why one should or shouldn't invest. So essentially, an investment thesis is the reasons behind your investment or behind why you shouldn't invest. The hope of the investment thesis is to provide a somewhat of a persuasive argument to the reader themselves or to the person who's getting the pitch as to why one should buy or should sell. So again, this is a example for tech resources itself. For investment thesis 2, it proposed it suggests that there's an increased supply through expansion of product. This exact pitch is a buy side pitch. So it is showing the upside potential and the possibilities that tech resources face and why one institutional investor should go in it. Typically, these are backed by valuations and risks and catalysts as to why one should invest. So let's take a step back even more. Financial statements. There are three main financial statements that companies report every quarter, indicating their performance relative to last year and last quarter. Those are income statements, balance sheets, and cash flow statements. A balance sheet is typically a historical statement that outlines everything that the company owns in terms of assets, liabilities, and shareholders' equity since inception to the moment of reporting. Balance sheets tend to indicate the liquidity of a company and its outlook for the near future. Income statements is what typically investors look for because it provides investors with more of the earnings that they own. Like I said in the beginning of the presentation, each owner of a stock owns the proportionate share that they own in terms of assets and earnings. And earnings are what institutional investors typically are more interested in. So income statements outline the company's period returns, revenue, and costs through a specific period. This is the one that again intrigues investors the most. And finally, cash flow statements show any cash inflow or outflow in operational and investing and financing activities. At the far right, we can see one of the lines. This is an example from Lockheed Martin. They just reported their earnings last week. And this is the line that investors typically care most about. It's the earnings per common share. This outlines to investors after deducting all operational expenses and all depreciation, amortization, all the assets that take away from the earnings themselves, what is left to the shareholder to each individual shareholder. So we can see that for the basic or diluted, we can see that there's a $7.44 earnings per share for that specific quarter and a $21.74 or $21.66, depending on basic and diluted earnings per common share. This is the line that typically investors look at to see if there is a growth in that margin or if there isn't, and determine if the stock is actually reinvesting itself and if there's any growth in the market itself for that specific stock. If the returns per share are typically stagnant and there's no growth in it whatsoever, that kind of somewhat signifies that the company is not reinvesting in themselves, there's no growth in it, there's limited potential in there, and that market and that investors should not shy away, but if they hold that stock, they should either hold or sell and not specifically buy, depending on, again, economic outlook and company itself. Typically, if there is a reduction in earnings, we can generally see in the market that as soon as earnings are reported, if they meet the analyst expectations or if they don't, then we can see the stock itself either plummet or rise in accordance to and depending on their stock. So if earnings, so for this example, for instance, Lockheed Martin met analyst expectations. They met their targets. They met of what everyone expected them to perform for the year of 2022. Therefore, we saw a slight incline in their stock price over the period of the last week. Some financial metrics and ratios that investors use in order to better determine whether a stock is a good stock to purchase or not. The first being earnings per share. Again, that one I've already discussed, which is your net income minus preferred dividends, over the weighted average number of shares outstanding. This tells you how much earnings truly that have been earned over that specific time frame, whether it be a quarter or whether it be a year, would be distributable or actually attainable to the shareholder themselves. Next, we have the debt to equity ratio. This ratio discusses a short-term debt plus long-term debt plus other fixed payments over a shareholder's equity. This determines the level of leveraging that the company takes on. And this is very important due to the fact, like I said, common shareholders and preferred shareholders, they receive their income. If the company was to file for solvency, they would receive their respective share of the company after all debt has been paid. If a company has a high debt to equity ratio, that could signify that the company would then not be able to provide as much income, whether it be in dividends or whether it be in capital gains to the institutional holders themselves. And therefore, this is one important metric to look at when comparing whether a company is over leveraged, if they are under leveraged, if they are not utilizing their full capabilities to expand or not. Typically, you don't want to have too high of a debt ratio, but then again, you don't also want to have too low of a debt ratio because that could also signify that the company is not investing in all potential areas that it could be invested. Third is the return on equity. This discusses the net income over shareholders' equity. This specific ratio discusses how much of the net income is actually attributable to over is divided, like when divided over a shareholder's equity, it discusses how much net income covers in terms of shareholders' equity. Therefore, it determines to the equity holders themselves how much return they've actually gained on their investment. So if I own a share in Apple and I paid XYZ for that stock and there's a net income for it, I want to see how much money was earned through my equity itself. And finally, a ratio that I like to use is a quick ratio. Quick ratio discusses current assets minus inventory over current liability. This is particularly one of my favorites because it shows you the liquidity of the firm itself. And by liquidity, I mean the level of cash present at the firm to meet its obligations. I'm sure all of you have heard this before. Cash is the lifeblood of a business, and there's a reason for that. If a company doesn't have enough cash or enough liquid assets in order to meet its obligations, whether that be short-term or long-term, they could very easily run out of business even if they are in a high revenue and high income environment. Cash is very vital for a business to meet its obligation. Therefore, I typically tend to look at this particular ratio in specific in order to actually determine if the company maintains a healthy quick ratio or not. Typically, you want to have a ratio of 1, which is having enough cash reserves to meet your current liabilities. However, that does sometimes depend on the industry itself. Generally, though, you want to have around 1 to 1.5 for your quick ratio itself. This is, again, very important in order to show institutional investors that no assets would have to be sold over, or no inventory would have to be liquidated in order to meet obligations, and therefore slow down the operations of the business itself. So valuations. I think I'll take a break here for a second to ask if anyone has any questions thus far.
What ratio are you looking at the most? Like if you just were to glance at a statement, or if you have top 3 ratios you have to pick, what are you giving the most?
Personally, earnings per share. Earnings per share is typically what investors, whether it be analysts, whether it be seasoned investors or beginner investors, that's what they kind of look at over their earnings per share. They don't only compare their earnings per share for that period, but they also compare earnings per share over the history of time and see if there's a trend that is visible through the earnings per share for the company. You want to see a positive incline in the earnings per share for that specific company because it tells you how much earnings is received for that specific share of that company. And again, it shows you how much income is possible for that specific share itself. I personally like the quick ratio because it shows you, again, like I said, cash is the lifeblood as business. If a company has very little cash to meet short-term obligations, it then again could see a large deficit, and that would definitely lead to a slowdown in its operations, if not, depending on the size of the company, termination at some times. So cash for me through quick ratios or even current ratios, which is only current assets over current liabilities, that would be one of the main areas that I look at. And finally, debt to equity ratio. I like debt to equity ratio because it shows me, again, like I said, the percentage of debt that there is in relation to the shareholders' equity. How much debt would have to be paid off before I receive my money back, and how much I actually have to, the level of riskiness that the stock itself carries in order for me to receive my money back. So these three items, these three ratios, I personally look at when I pick my stocks, and you want to see somewhat of a positive trend in all of them, and that's somewhat what you should be looking for.
Awesome, thanks. I think Noah had a question for.
Yeah, go ahead now.
Yeah, I was just going to ask, what are the specific things that go into calculating the cost of capital?
The cost of what, sorry?
The cost of capital.
Cost of capital?
Yeah.
So cost of capital typically includes your cost of debt and your cost of equity, depending on the weight that they're in. So if you have, we'll discuss that in a second, actually, in the free cash flows. Your cost of capital depends on your preferred shares, your common shares, and your debt. You multiply the cost of debt, which is how much you pay for your dollar of debt, by your weight of debt itself in relation to equities and into relation to common shares and preferred shares themselves. Then then common equities, your cost of equity goes into the cost of capital again, your weighted average cost of capital, and your cost of capital your cost of equity, is calculated through the company's beta, the risk on the market, and the risk-free rate. The risk-free rate, like I said, is a 10-year treasury bond. The return on the market is the return on the industry or the market that the stock specifically operates within. And the beta is the correlation, not the correlation, it is the relationship between the return of the stock compared against the return of the market in which it operates. So if we see a stock that has a beta of 1, then they return the same amount that their respective market returns itself. Then you also find out your cost of preferred stocks, your preferred stocks, which is how much you have to pay for each dollar of preferred stocks. Multiply each of those costs of equity and cost of debt by the respective weight. That will yield your cost of capital, which would then go into valuations themselves.
Thank you. That was a great description.
Any other questions? Okay, so valuation. There are typically several methods of valuing a company itself. The most common, however, is a DCF. A DCF stands for a discounted cash flow model. This projects the company's financials over a specific period of time in order to come up with the yearly free cash flow to the firm. The free cash flow is the amount of cash that the company has available after meeting all of its financial obligations, that being debt for its shareholders, any obligation that isn't retainable to the company, i.e. their shareholders themselves, which in a sense is the cash flow remaining, again, the common shareholders after all parties have been paid. Free cash flows are then discounted using the company's cost of capital, as I just explained to Noah, yielding a final implied price, or what the analyst projects the price to be. So if you look at the top right, you can actually see a model of a discounted cash flow model where we project the financials of a company depending on their different sub-organizations or different sectors that they operate within, projected over a certain period of time. We then find out the EBITDA of the company. We remove depreciation, find out the EBIT, which is the earnings before interest and tax, remove tax, which would then leave us with a NOPAT, which is net operating profit available after tax. We then add back depreciation for the fact that depreciation is not a cash account. We then add back capital expenditures and remove the changes in net working capital, yielding us the free cash flow available to the firm itself, and then discount it using the actual discount factor, which is our cost of capital. In this case, this was done for WSP, which gave us a discount factor of 10.28%, which is our weighted cost of capital. And essentially, our cost of capital is how much return you expect for the risk that you take, for the risk that you undertake. So if I put in $10 worth of shares in the specific company, I expect to return 10.28% on my investment for the risk that I'm undertaking. We then move on to the valuations through comparables. The comparables analysis looks to compare a company of your choosing against its top competitors. This one is the simplest of the models. You can find a lot of this information on Capital IQ, which is available to all Ryerson students, Ryerson alumni. Comparables analysis looks to assess a company's performance through several multiples and analyzes the performance of those specific multiples against its competitors. The hope is to be able to assess whether a company is overvalued, correctly valued, or undervalued relative to its peers and competitors. So in this comparison, we look at the bottom company, which is WSP. That's a company of our choosing. We then look at its top competitors, that being AECOM, SNC-Lavalin, Santec, Waste Connections, and Badger Infrastructure. Then we choose one of the trading multiples that we have available. would that be total equity value over EBIT, last 12 month EBIT, EV over EBITDA, EV over revenue, or PE over the PE ratio, which is price over earnings per share. We then look at WSP's earnings PE ratio, which is 25.6 in this case, and then compare to the industry average. And I mean, if we look at the industry average for the PE ratio is around 26.3, whereas WSP is around 25.6. So we can tell that WSP is somewhat correctly valued. They are in line with they are in line with their competitors. They have the correct market value. They are not undervalued or overvalued for you to take a position in that specific stock. There is a little bit room for you to gain a little bit money in that specific stock. However, it is very marginal. We can also look at other metrics that we have available, such as their EV over revenue. We can look at their EV over EBITDA and so on. We can see that they are somewhat in line with what the market standard is, and therefore they are not over or undervalued for that specific case. Finally, we have the valuations through multiples analysis. This is one of the easier tools to follow and apply to each valuation. After selecting the appropriate multiple that you want, so in this case, it's the next 12 month EBITDA multiple, we then apply to the firm itself. So we find the EBITDA multiple itself, which is available through various websites. You can find various iterations of these multiples, whether it's on Capital IQ, whether it's through a Bloomberg lab, whether it's through Yahoo Finance, Factiva. There's a lot of websites out there that can provide you with a EBITDA multiple. You would then multiply it by the company's actual next 12 months EBITDA or last 12 months EBITDA, that depending on your multiple itself, reach an enterprise value, which is your hope, add back cash, deduct your debt and minority interest, leaving you with the equity value and divide it by the number of shares, which gives you an equity value per share. That would give you an estimate of what the price of the stock should be if the market was in a perfect condition and that institutional investors all had the same information, which is a market belief that all the market corrects itself and that all institutional investors have access to the same information, and therefore the market is perfectly correct. So if we look at the actual equity value per share in this case, we see that in the base case, it's around $66.02. Whereas the share price in that specific day was $47.63, meaning that there's an implied upside of 37.5%, meaning that you should be able to take a position on that specific stock and make money back and be able to actually reap the benefits that institutional investors have yet to actually believe in. This was actually done back in November, and since then, the share price has reached its target around $65.50. And however, this is no advice whatsoever. This is no professional advice whatsoever. You should still apply your own valuations and logic to it. Any questions?
Yeah, Hamza. So just going back to the comparables analysis, are there circumstances in which you would choose one trading multiple over another when looking at specific stocks?
Depends on the industry and the company that it operates within. There are certain multiples that are more appropriate to the industry itself. There are certain multiples that are more appropriate to the company itself. If you're comparing it against a industry, if you're looking at this industry in specific, you could go for any of those multiples in specific. But however, again, it's very variable and it's very subjective to the industry in which you operate. So some industries might might not have a comparable revenue range where you cannot compare the EV over revenue. Some might not have a very similar EBITDA, so you might not be able to actually apply that specific multiple itself, itself. So it's very subjective to the firm itself and to the industry in which it operates. Typically, if you're looking at big company stocks, you're not gonna have that much of a trouble with finding comparable multiples. However, once you start looking towards riskier small cap stocks, then you are going to be facing difficulties finding the appropriate multiple when comparing it to its respective comparable companies. It's an extremely subjective example. It's very subjective to the stock you face itself.
So like if I were looking at something like a small high growth tech stock that is still not profitable yet, what would be some multiples that I might want to look at?
If you're looking at a specific non-profitable stock itself, again, you could look at something like EV over revenue, because that'll give you, then again, they might not be profitable, they will have revenue. So you could focus on stuff that are, I wouldn't say more generic, but that all companies typically share. So EV over revenue would be a more reasonable stock a more reasonable multiple to actually look at. I wouldn't look at, for instance, PE ratios, because your earnings are not going to be as helpful in that specific example. But again, you're going to have to pick and choose that specific stock itself and then see what works for it, which EV over which multiple is more suitable.
Perfect. Thank you.
Any other questions, Brendan?
Hey, Hamza, I had a question. How do you know what other companies for the comparables are?
Yeah, perfect.
Yeah.
Uh, Generally, you want to go for companies that are of similar size to the company itself. So you could look at the market cap or the enterprise value. They want to have somewhat of a similar characteristic. They also have to operate within the same industry, of course, and they have to have the same line of operations. So in this case, WSP, ACOM, SNC, Waste Connections, all of them share a very similar industry. All of them have a very close market cap. So you want to look at companies that are comparable in size and comparable in structure itself. That's typically what you want to go for. So it depends. So if you were valuing tech stocks, you wouldn't value Apple against a smaller cap company. You would value it against a company that's of similar stature, of similar size, with similar revenues and similar profits.
It makes sense. Also, is there like a limit on how many companies we can compare it to, or we can just compare as many?
There isn't a specific limit. There's no really industry standard to how many stocks you should have. You ideally want to have at least 4 to 5 stocks minimum, so you can have somewhat of a reference point to actually look at. You don't want to be just comparing it to 1 or 2 stocks, unless that's in a very unlikely case, you might only have 1 or 2 stocks to compare it to. But generally, you can compare it to as many stocks as you want. It'll give you it'll give you better data for the average and median. But generally, you want to have at least 4 to 5 stocks to compare it to, so you can have better numbers for your mean and median, and then your ratios.
Okay, thank you.
Or Sahil, I don't know.
Yeah,
I'm
yeah. I just wanted to say something based on what Anthony asked earlier. Like,
Yeah.
Hamza said, like PE ratio might not be good for that, but like if you look at a PEG ratio, which combines the PE ratio with growth, that might help you for like a company like that, because you're kind of pricing in their growth into the formula. That might give you a better overview, because you'll have a high PE, but if you're growing at like a high percent, like you're doubling every like year, then you might look more attractive down the line and your PE ratio will decrease, etc.
Yeah. And then again, like there are multiple ratios. First of all, thank you for the intervention. But there are like Sahil said, there are multiple ratios out there, multiple trading multiples out there that you can look at that would be better fitted for your specific stock. It's just about picking the specific multiple for that specific case that you're looking at. We all have Capital IQ is all accessible to all TMU alumni. So it would be there's a subsect on the actual page itself on Capital IQ that you can go to, which is the multiples tab. You can find several tens of multiples that you can look at and find the most appropriate one for that specific stock that you're looking for.
Yeah, and also with what Brendan asked earlier, like if you look at like the comps table he made, like you kind of want it to be like as similar to your company as you could get. So like you kind of want like the enterprise value to be the same. You kind of want the multiples will be in like a close enough range. You might want the market cap close enough. So this way you're not comparing a company with like $100 billion market cap to something with like 1 billion, right? So you can make your peer group as big as you want, but it has to make reasonable sense. So like you might say, you know what, my company's 20 billion. I want companies that are anywhere from like 15 to 25 billion. If they're within that range, they're kind of like our company. You could look at business models as well. That might help you.
Yeah, exactly. Like I said, you want to look at comparable companies that are similar in size and similar in performance. You don't want to compare companies that are, like I said, like that are too far apart, because then again you would have skewed results and it wouldn't make sense comparing a big market cap company to a small cap company. So you want to look at companies with similar market cap, similar enterprise values, similar trading multiples, again similar in size and similar in structure. Those were performance. Sorry, those would be that would be the advice I could give you, but there's no specific limit. If you can find 100 companies with a similar enterprise value and similar market cap and similar trading multiples, then by all means, you can add all 100. Any other question? Okay. We're in how to invest. There are several platforms that exist that allow investors to put their money in and invest in the stock market at the moment. Some of you might be seasoned investors, some of you might be beginner investors, some of you may have not invested at all. I myself, when I first started investing, I didn't know which platform to use, which ones to look out for, which ones to put my money within. There are the top 2 right now, I'd say, are Wealthsimple and Questrade, available here in Canada. Wealthsimple, unlike all of the other competitors down below, don't have a transaction fee, so you can have as many transactions without no specific minimum for the amount of money that you can put in or withdraw, with no transaction fees whatsoever. Questrade, TD, CIBC, Direct Investing through RBC and BMO all have a transaction fee, and some of them have a minimum amount that you can put into your account at that moment. Big banks as well, I think, as well as Questrade, also have analysts that give you reports and give you performance updates for the stocks that you're within. that you're purchased, that you have purchased. So there are benefits and drawbacks to each of those respective trading sites. Wealthsimple isn't going to give you the same advantages that TD, RBC, CIBC, and BMO have of allowing you to actually talk to a representative from those respective banks and give you some insight and match your plans and expectations. Wealthsimple is more of a self-guided journey where you just invest on your own with no guidance whatsoever and no expected returns. TD, RBC, CIBC, and BMO all provide platforms where you can give your money to a relations manager, an investors manager who can then manage your money on your behalf, depending on your needs. So some people might be looking for dividend stocks that provide them with a consistent stream of cash flows over 30 or 40 years. Some people might be looking for low growth and want less risk, and therefore they could invest in ETF and low risk stocks with lower beta. You can also, some investors want a higher yield over a shorter period of time, so they can go into riskier stocks and riskier investment portfolios. Wealthsimple, unfortunately, is more of a self-guided journey, unlike those other institutions where you have to invest on your own through your own beliefs at your own time with no guidance whatsoever. Wealthsimple also has a transaction period, so it takes you after you submit a transaction, it takes 3 to 5 days to go through. That is one of the drawbacks, whereas CIBC, TD, RBC, and BMO typically happen on the spot during trading hours, of course, which is from 9 to 4:30. And then, so then again, it depends on the investor themselves. If they want to invest a smaller amount of money, then I'd personally suggest Wealthsimple because they have no transaction fees. If they want to invest a larger sum of money with more direction, then I'd suggest going to your local, to your personal bank, talking to a advisor over there and letting them know what your targets are. They can also help you open up a investor's edge account or direct investing account and adjust your TFSA for it or RSP and invest through it. So how to pick your stocks, depending, like I said, on your needs. Some people are risk averse and target stocks with lower risk and lower returns, such as Spider's SPY, which again mimics the S&P 500 perfectly at a price of $400 as opposed to S&P's actual price of around $4,000. You have also institutions such as Vanguard. Vanguard has a variety of ETFs depending on your needs. Some people prefer energy stocks and they might go into something like VDE, which is a energy ETF. Some people might prefer a growth index fund, which is something similar to VOOG, which is a growth index fund that allows investors to experience more growth. So, for instance, during 2021, Vanguard has their VOOG, which is their growth index fund. It returned approximately around 31%, whereas their S&P 500 mimicking fund returned approximately around 25%. You can expect a higher return, but then again, you are facing a higher risk. So there's a variety of investment techniques and stocks that you can pick that would meet your needs. It's better to ask yourself what you want out of the money that you're investing, and that way you can actually build it off. If you want to face a higher risk and maybe expect a higher return, then you can go for riskier stock. If you want to grow your money over a period of time and become a seasoned investor and just put in a regular amount of money each month and invest that over a period of time, then you might want to look into something like an ETF that would be better for you. And then again, it strictly depends on the investor themselves and what they actually want to do with their money and what they expect from it. And thank you for attending. If you have any questions, please let me know.
Awesome. That was really a lot of information there in that presentation. I hope everyone was taking a lot of notes, especially if you're an equity analyst who's on the call today, or anyone who's trying to learn it. The purpose of this presentation was to really show you or try to show you the scope of equity analysis and every variable that goes into it. There's a lot of things that we encourage you to note it down and or on your own time, if you will, because you can only cover so much in 1 hour. That was awesome. That was really informative. I do have one question for you, Hamza. For the equity enthusiasts here, what is your current outlook market? Should I invest? Should we not?
Yeah,
of course, it's not advisory.
No, this is in no means any professional advisory whatsoever. It's a very bearish market. However, if there's a time to invest, it is now. It's not going to stay bearish forever, like I said, like we showed in at the beginning of the presentation, where we actually looked at trends in the market. There's always an upwards trajectory. So we might be in a trough right now. We might be in a recessionary environment, and it might get worse over the next 6 to 9 months. However, I have a positive outlook in 2024. So if you put in a sum of money right now, you might lose on it a little bit over the next 12 months or so. You might lose 5 to 7% on that money, but next year you could expect to earn a little bit more than 5 to 7%. I personally am expecting a lot more next year as the economy corrects itself, and hopefully the Federal Reserve did not overshoot with their interest rate hikes, and we saw the last interest rate hike today. So personally, while it is a bearish market, there is no better time to invest than in a bearish market. And while that might sound contradictory, it is the matter of the fact, because as you can see here in the 2020 dip, for instance, if people remained on their beliefs that, oh, I shouldn't invest, it's a bearish market, then they wouldn't have reaped the benefits of around 25 to 30%. However, people tend to invest in a bullish market, which might gain them 10, 12, 13% for that year. But then again, the market always follows a similar trend, and we might go through a trough in a year or two following, and they might lose some of the money that they made. So in my personal perspective, I think now is a good time to purchase, and you can expect a decent return on your money over the next year or so.
Right. Yeah. That in by no means is financial advice. Just start opinion.
None whatsoever.
Yeah. Just start on. All right. So I think Sahil has a question.
Yeah. Go
I
for it.
just wanted to comment. Like basically, if you look at the chart Hamza has up top, talking about the peak, the growth, the trough. If you look at the blue line, it's essentially the average. And if you think about the market, it's always mean reverting. Why is it mean reverting? Is because you expect our country to grow as a whole, and our country is basically made up of companies. So you investing in like the downturns is like if you have cash available and you're comfortable investing during the downtimes, you know it's going to mean revert, right? And you could also set up like your asset allocation however you want. You don't have to do all equities. You could include like 60-40, which is like what a lot of people do, 60% equities, 40% bonds. That's something you could look at as well. But generally, because the market is mean reverting, you're better off like averaging into it. And then maybe at downturns, you invest more than what you usually do as a way to like, oh, I'm going to have a little bit more risk appetite.
Yeah, that's definitely true. And well, like we said before, if we look at the stock market over the last, I don't know, 50, 60 decades, we can see that there's an average return on the market of around between 10 to 15% per year. And that's average, even during down periods. The years after, it makes up for the down period. So like you said, it's mean reverting. We can expect the market to continue to grow if we continue investing in it. We can expect companies to continue to grow and to continue to develop. So it depends on the investor. Some people aren't as risky and they don't want to invest during slower times because they might fear losing their money. I personally, I would invest at the moment. This is not professional advice in any mean whatsoever. Because again, if and when the market does correct itself and we see a grow again in the market, we can expect a higher return on our money at the moment.
Like one comment for the market right now is it's not going to be like it was during COVID time, because that was kind of like a V-shaped recovery. That was pretty quick. Usually these things take like a longer time to play out. The thing that definitely. All like federal bodies controlling like interest rates, etc., took into account was the interest rate. And now that rates are high and they might continue hiking, right? Like they care about more inflation than like what happens to your stock. And this is like their mechanism. So they're gonna raise rates. Let's say they raise rates a little bit more. And then if they see like serious pressure on the economy, then they'll start lowering it a little by little, and that might push your equities a little bit higher. But it's going to be prolonged for like more than during COVID times for sure.
Yeah, it's definitely, if you look at the 2010, 2000 and between 08 and 2011, that's during the financial crisis of 2008, 2009, we can see that there is a big slump in the market, and then again, it takes quite a bit of time to reach the point where it was beforehand. But if you invest at a times where the market is in a lower environment, you can expect your returns to be higher than if you invest at a peak environment. So it definitely it's not going to take like 6 months like COVID did, but it will take quite a bit of time. But now is a better time to invest than at a peak, for instance.
Yeah, you could like dollar cost average, where like you bring your overall price down. Even if you bought at the highs, if you continue buying long term, you bring that price lower, and eventually you'll get like a return, right? So you could look into dollar cost averaging as well.